Welcome to the Market Guys Live. I'm AJ Monty. We have an action-packed program for you, starting off with our rapid-fire stock analysis and Q&A session. Later in the program, we're going to have two special guests for you to talk about alternative investments and what you could do to find a money manager. Of course, that's if you're looking for one. There's a lot of investors out there that are fairly confused over the direction of the market. One week we're up, the next week we're down more than we were up the week before. And again, confusion sets in. That is also known as volatility. Usually when a market reaches a top, you will see the beginning stages of this volatility, and then the technical indicators start to give us some signals as to when the sellers or the buyers are shifting control. Now, again, we are going to take technical analysis as the main tool. We're going to look at your stocks, and please, if you have any questions, just let me know. You have a live Q&A box that you can type into right now, and we'll take those questions one at a time. Before I get into your stocks, what I'd like to do is take a look at the general market. Just look at the overview, look at the Dow. We can look at the Qs, which is the NASDAQ market, and we could even look at the S&P or the Russell 2000. I'll take a look at this with you, and you can see where the support and resistance areas are stacking up. To start off, let me go to the diamonds. This is the DIA. This is the Dow Jones Industrial Average ETF. And this is a one-year daily chart. And you can see here, as I zoom in, you'll see that we have a turning point. Actually, you see the market starting to go down below the 20-period moving average right there. Just 3 trading days ago, this was late last week, we saw a big red candle that gave us that signal that the sellers were coming in. When a stock starts moving down below that moving average, things start to shift. Institutional traders start to lighten up on some of the positions. Investors who know what they're doing start to put stop-loss orders in. And from there, you can see protective measures moving as people get more defensive. Now, today, we had a doji, which is a sign of indecision. What I expect to see happen in this particular market is I expect the market to go up slightly at the beginning of this week, maybe tomorrow, Wednesday, and it will retest that 20-period moving average. And this is a shift in the supply and demand where the sellers start to take over. Now, if you're owning stocks and you are not using protective stops to protect your position, then you're making a very big mistake. And I'm going to stress the importance of risk management throughout this program, and hopefully we can get a couple more people using those stops. Now, that's the diamonds. If I take a look at the Russell 2000, which is a more broad-based index, you'll see the same thing is happening. We are moving down below that 20-period moving average right there, but you can see that the candles are getting a little bit longer. This tells us that the movement on the downside is increasing and that there's less buyers coming into the market at that particular point. If I shift my chart to a weekly chart, it's going to look a little bit different. As you can see that the weekly moving average, and this is a 20-week moving average, is now being tested. A breakdown below that 20-week moving average is really going to be the triggering of the sell stops that I just talked about, and you'll see volumes increase. Now, as I go to the Qs, this is what I started off with at the beginning of the show. This is a weekly chart of the Qs, and if you look straight down, you'll see a big red candle from last week. What does that tell us? Well, red is when the sellers start to come in, and when you see the volume of the selling activity increasing, that's another sign that we need to protect. Now remember, technical analysis is not a tool that I use for forecasting the future. It's not a crystal ball. It's not tea leaves and different kinds of voodoo magic. It's strictly a report on the supply and demand and how the buyers are stacking up against the sellers. If you see an increase in the selling pressure, like we're seeing in that volume right there, then you have to watch out. So for the Russell 2000 and the Qs, what you want to do is you want to draw lines of support. A line of support that I just drew on that chart right now is nothing more than a horizontal line marking the point at which buyers historically came in at that particular point. If the market starts dropping down below that red line, aka the support level, then you need to either get out of position or hedge yourself in the option markets, which maybe we'll get into in another show. Now, if you take a look at the volatility index, this is also known as the VIX for short. The volatility index tells us the level of emotional premium in the market. And if you look back at a monthly chart, I'm going to go back 10 years. I talk about this quite often. If you look back at a 10-year history of the VIX, you'll see that we're on 10-year lows. Now, please keep in mind that the volatility index is a contrarian indicator to the S&P. So in other words, when the VIX is moving down and the volatility is shrinking, the S&P 500 is starting to move up, or has been moving up. So it's opposite to what the S&P is doing. Now what I'm expecting is the VIX to bounce off of this key support level. If we get a bounce in the VIX, what's going to happen to the S&P? Well, obviously if it's contrary to the VIX, then the S&P is going to roll over and start to go down. So another reason why you need to protect yourself. Before we get into your stocks, then I'd like to really take a look at some of the gold markets and the precious metals, the silver markets. Recently, there was news that came out of Cyprus that Cyprus was selling their gold position to offset some of the negative economic woes that they've been having. Now, think about this for a second. If you have a country that's selling their gold reserves to meet their economic responsibilities, then something is awfully wrong with that country, because what happens is the gold that's leaving the country is no longer backing that particular currency. And if you have worthless paper, what happens to any country? Well, when the paper or the currency becomes more diluted, you have inflation that sets in. All the more reason to be buying precious metals. So the news that came out last week did not make any sense to me, so I put a recommendation out to our client base to get involved in the gold markets, and that was a good thing, because if you look at the daily chart of GLD, which this is the ETF for the gold market, if you look at what happened last week when I put the buy recommendation out, not a result of my making the recommendation, it was simply a technical bounce. You see that gold made a significant bounce after a severe move after the news in Cyprus. So I still continue to be bullish on GLD and some of the other gold contracts and gold securities. But remember, even if you're bullish on gold, you have to set some sort of protective stops or defensive measures in place to be able to protect your position. Okay, let's go to the Q&A box. For those of you who are just watching on the show and not participating live, you have the ability to plug into our go-to meetings where you could submit questions and stock symbols. And what I'm going to do right now, so I'm going to take a couple of the stocks that are coming from our audience. Let's look at Paul out of the Tampa area, NFLX. He's looking at Netflix. Netflix has had quite a history of volatility. If you take a look, this is a one-year daily chart of Netflix, and you can see that back in, what month is that? That's back in January of this year. Netflix rallied up, and it didn't even look back. It was very positive news on Netflix. But what happens when a stock rallies up and leaves a gap, just a gaping hole in the chart, what happens is most of the time the stock moves back towards that gap, hence a filling of the gap. So gaps become price targets for us and becomes an opportunity, especially for the option traders who are looking for short-term profits. Now, Paul, if you take a look at Netflix, you'll see that today we had a green candle, a significant green candle on higher volume. Now, notice where the stock stopped its activity. It closed right on that 20-period moving average. So tomorrow and throughout the rest of this week, we're going to have to watch Netflix to see if it holds levels over that 20-period moving average. If it doesn't do that, then watch out below. So what you need to do, Paul, is put a protective stop underneath the support level, which I'm putting just over the 160 level. If you look at that red line, that's right around 161.15. So, Paul, if you're owning the stock outright, that puts your stop below 161. Don't look at the stock every single day. If you have a protective stop and the stock goes down, then the stop loss order will automatically sell you out of the position. You won't have anything to worry about. Now, for the option traders who are following the trade alert service that we put out through the Market Guys, you'll know that we have a position in Netflix. We actually have a spread position that allows us to make money while the stock is kind of hovering in this trading range. We expect the stock to eventually come further down to fill the gap, and we're positioned accordingly. So for the option traders out there, follow along with the trade alerts and you'll be right on target for your profits as well. Let's take another stock. We have Ralph looking at EWJ. Ralph, I don't know where you're calling in from. It doesn't show right there, but EWJ is going to be the iShares. This is the Japanese industrial fund, and you could look at this and you can see that for the past year, this EWJ has been going up quite dramatically with the rest of the market. Now, there's some warning signs that I have to tell you about that you need to pay attention to, Ralph. If you look at the angle at which this price has been going up, there's been times where there's been vertical growth in the price action. That's not necessarily a good thing for long-term investors, because when you have prices going vertical, eventually what will happen with those prices is you'll see a corrective move as the short-term investors or traders start to take their profits. When you have a profit-taking move, selling pressure pushes that price down. So I have to tell you that if you're thinking about buying this one, I would wait for a bounce off a support level, because it shows me that you don't own it yet, but you're thinking about buying it. What I would do is wait for the gap to fill. There's a couple of gaps down here. Wait for the gap to fill right around the 1060 level, and then look for a green candle, which is your sign that the buyers are coming in. At 1060, if you get a green candle and it's bouncing off of that support level, then you can join those buyers and not try to catch a falling knife on the way down. A lot of the investors that I talk with are always trying to buy stocks at a cheaper price. If you think about this, what happens is if a stock is going down, the stock price is being controlled by the sellers. And if the sellers are controlling the price and you're trying to buy while the sellers are controlling that price, then chances are you're going to buy the stock and the sellers are going to continue to push it lower. Hence the old saying, don't try to catch the falling knife. Instead, wait for the stock to bounce off of a key support level and then buy on the green candle when the buyers are starting to come in. The probability of you making money dramatically increases at that point, because you're now on the buy side and not fighting the trend set forth by the sellers when the stock was going down. So I'll tell you, Ralph, if you look at the $11 area, wait for it to bounce off at 1060, maybe put an order in to buy it at 1080 or 1090 after the stock is bounced, and then put your stop below the $10.50 mark to protect your position. Okay, I'm looking for questions. If anyone has any questions, I'll take those in between the stock symbols, and then we'll go back into our rapid fire stock analysis segment. Okay, let's see. Thinking of buying, and this is Gerald. Gerald is thinking of buying XLF. I'll wait for those questions to come in because I know there's a little bit of a lag there. XLF is the Amex. This is the Spider Financial Select Fund. And you can see that this too is now dropping below the 20-period moving average. Now let me hit the pause button here for a second, and I'd like to give everyone a short lesson on the moving average and why that's so important. Years ago, we had an encounter with a guest named Jim Roebuck, and I'm going to give Jim a plug here right now because he, for the longest time, has been known as the Zen of market timing. And Jim had a very simple philosophy where he would only buy stocks that were moving or crossing over the 20-period moving average. Now, I have to keep in mind that Jim was not the only person doing this. Moving average crossover method has been around for many, many years. Yet, the more people follow that signal, the more powerful the signal becomes. You could think of this as self-fulfilling prophecy. I don't care what you call it. The fundamentalists go crazy over this because they're saying, oh, that's just people pushing the market where it's going to go. Well, I don't care what you call it. If I have a group of buyers moving in simultaneously on a buy signal, I'm going to move in with them, and I'm going to protect myself. Because if the buyers have their way, they're going to be able to push the stock higher, and I will be able to make a profit. Now, right now, this particular stock is now moving down and crossing below the 20-period moving average. What would Jim do? Well, if Jim was here sitting talking to me right now, he'd be selling out of that stock because that's a sign of weakness. Make sure that you're buying stocks in strength and selling them during weak times. It's a simple philosophy. It's not rocket science here. You buy strength, sell weakness, and move on your way. Now, this is a trading strategy. This is more short-term, swing trade strategy. And for those of you who are not familiar with swing trading, it's a way to capture profits from much shorter-term price moves. These are mini trends or intermediate trends. And if you can find the signal and get in during one of these pivot points, you could do extremely well for yourself. Now, investors, on the other hand, would use a similar method, but they would just look at a longer-term price chart. I'll show you what I'm talking about right here. If I switch this to a weekly chart, you'll see it's going to look a little bit different, a little bit more compact. We have more time on the screen. This is a 3-year weekly candle chart. And you can see that back in September of 2011, that's right where the stock started to pivot and go up and move into that trend. But if you notice that this stock has been over that 20-period moving average for a long period of time, actually since the summer of 2012. Now, as an investor, you use the same method. Instead of looking at a day chart, you look at a weekly chart. And when that stock closes above that 20-period moving average, and in this case it's a 20-week moving average, you would buy it, and then you put your protective stops along the way. And as the stock goes up, you move your stop up with that stock. Now again, for those of you who are new to trading or investing, I'd like to let you know that the stop loss order is one of the greatest inventions that you could ever use to protect your money and to protect your portfolio. All it is a simple instruction that you put into your broker to give them that instruction to sell out of my stock when it goes down to a certain level. Here's an example. If you buy this stock at $17.57, which is where it's trading right now, you can put a stop loss order somewhere below that moving average. If the stock drops to 17 and the broker has your stop loss order in place, what happens is it could still be trading $17.57, but if it drops down to 17, it will automatically sell your stock out and you're protected. The most you will lose at that particular point, in most cases, is about 57 cents. So if you buy it at $17.57, put a stop at 17, at least you have some protection in place. Now, what we're going to do right now is we're going to take a quick break for our sponsors, and we're going to come back and answer some more of your questions and also take a look at your stock symbols. So stand by. We'll be right back. And welcome back. In the studio with us, we have two gentlemen. One is Chris Meikle. He is a financial consultant with International Assets Advisory. And remotely from Tampa, Florida, we have Dave Wood. He's a senior vice president for eFloorTrade. Welcome, gentlemen.
Thank you.
Thanks for having me. Great to be here.
I'll start with you, Chris. You know, we have a lot of people that are looking at the markets go up and down. We saw gold taking a big hit recently, a beating, yes. And now there are investors wondering, what am I going to do with my retirement? Where can I put my money? It's not going to have so much volatility. I know we had talked about REITs. And I think a great place would be to start is with REITs and really defining what a REIT is, because there's so many different types of contracts you could get into. You really have to watch out and make sure you're getting in the right one. Why don't you tell us about that?
You know, AJ, and again, thanks for having me. It's great to be back on the market, guys. In the REIT space, it's Real Estate Investment Trust. It's an acronym. And in the REITs there's as many REITs as there are buildings that you drive by on the side of the road and when you're driving home and to and from work every day. There are REITs that invest in shopping centers, strip malls, office buildings, hospitals, medical facilities, you name it, factories, you name it. And what is interesting about this space is, as our viewers I'm sure are aware, there's been a lot of talk about real estate, but it's mainly been in the housing sector. where the hedge funds are starting to come in and buy, or in these institutional investors, large pools of money are coming in and buying up blocks of residential homes from either the banks or Fannie Mae or one of the large other institutions.
Right.
So, and investors are really flocking into that space. I mean, you're finding, and you read in the paper every day about
it's a structured product. It's not where you have to go out there.
Exactly. And what you're finding is that people are putting money back into real estate, trying to find other avenues to generate returns in their money. Now, with REITs, there are two different kinds, the two basic kinds. There are the publicly traded REITs, and you may have heard of Simon Property Group, for instance. They're the largest mall owner in the United States, regional mall owner. They trade under the symbol SPG on the New York Stock Exchange. They're a publicly traded REIT. You can buy their stock just like you would buy Chevron or AT&T. Then on the other side, there are what are called the non-traded REITs. Now, non-traded, these do not trade on an exchange. They are publicly registered securities, publicly listed, meaning they still have the same due diligence process, the same registration process with the Securities and Exchange Commission as a publicly traded stock would.
Now let me ask you a question. With the publicly traded REITs, obviously they trade like a stock. We have SPG on the screen looking at that right now. It's had an amazing run since really the end of last year when it's trading 147. It's up to 175 right now. You could protect that with a stop just like you would a stock. Is that correct?
Oh, absolutely. That is again, that's a stock that's going to trade like any other. It has a market, as you've discussed, has a market maker. So you can put in stops, you can daily liquidity, you can buy and sell that one 4 times a day if you'd like it, if you're so inclined.
Now the non-publicly traded ones, do they have the same benefits for risk management, or is that more of a managed account?
The non-tradeds are sold by prospectus, meaning that they are subscribed to. You enter a pool of money with other investors, again, fully disclosed by the 500-page prospectus, and you are again put into a pool of money with other investors, whether they be other individuals like myself or like you, or other institutions who are all given the same share class. And what the non-traded space can offer an investor is little to no correlation to the overall publicly traded stock markets. So when you have a non-traded REIT, there are shares, but there are a limited number of shares based on the amount of the offering that the company wants to raise.
So if you want to take some money from an account out of the stock market, you're not comfortable with the volatility that's over there, you can allocate a portion of those to a program that you're talking about and feel better, at least, that you're not tied to the market volatility. It's completely separate.
Exactly, AJ. That the non-traded space, again, these are publicly registered securities. You own shares. You could touch it and feel it, but the share price is based on the value of the portfolio. And it's not based on what the market may think it's worth. And it's also not; these are also not subject to the market inefficiencies that you have talked about on numerous times about when a stock falls out of favor. It may not necessarily have anything fundamentally wrong with it. It's just the stock or the sector fell out of favor. The non-public, the non-tradeds don't have that. Every month on your statement, it's going to be the share price is going to be the same, usually at a $10 par to start. And then the portfolio is revalued on an ongoing basis, usually after the first 12 to 18 months, and then the share prices are adjusted accordingly.
Would you say that the publicly traded REITs are more for the self-directed individual and not so much someone who's looking to have someone manage their money? Or how would you look at that?
I would, AJ, and the reason I say that is because the self-directed individual are our viewers and listeners out there who may take, whether it's a portion or all of their money, and invest that, and they like the real estate space, they can use your strategies on that stock. and use whether they like technicals or they like fundamentals or a combination of the two. In the non-traded space, it really bodes well for the investor to seek out advice from their financial advisor and to get all of because there are pros and cons to each. In the non-traded space, what I have done for many of my clients is I explain that there are holding periods here. If you are looking at this as I'm just going to buy it and try to trade it and then get rid of it in a month or two, that's not going to work.
No.
These you have to subscribe to, and it's much like a hedge fund that you would traditionally hear about, where you are going to have your money at work for you in this investment for a period of time.
All right. Now, Dave, in Tampa, for the person who is not the self-directed, your company is geared more towards helping someone find the right money manager. Could you tell a little bit about what you do and how people could take advantage of companies like yours?
Sure, absolutely. Our client base, first and foremost, we need to know as much as we can about our client base, but then we help facilitate the due diligence process when they are selecting a fund manager. Typically, our client base is looking for alternative investments. They're looking for investments not correlated to the traditional investment space. So we help them through that process. We have a core group of managers that we're very comfortable with. We're comfortable with sharing their performance numbers. Their customer service is solid. We feel that their transparency is good, and the liquidity for the client is also very good. So we help facilitate that process and help them select the right manager for their goals and as far as where they want to go with their investment strategy.
Now, do you also deal in the futures markets? We don't have to get into the specifics of what's traded, but for someone who is looking for an alternative to equities, bonds, and such, even the gold market, you want to take a break from the gold market, you can do that. What are some of the products that your clients are directed to or comfortable with?
Right. Well, we have some short-term corporate debt fund that is done rather well that we're very comfortable in sharing. We have some trend trading systems that we're very comfortable sharing with people. Long-short commodities trades is a good space. We're very comfortable with actually some hedge funds that have some very long, solid track records that we share information about them as well. Even folks that are doing their own trading through a system or a philosophy that they're following, we help them execute those trades. So we try to fit into all of those spaces.
Well, thank you so much. And I want to thank you both for joining us in the studio today. It's a great break from the rapid fire stock analysis. You know, not everyone is a trader getting in and out of the market. It's great to know what else is on the menu there. And when someone's looking, you're the gentleman that people are directed to. So again, thank you very much.
It's a pleasure to be here, AJ.
And I'd like to thank our viewers and those who joined us on the web with the rapid fire stock analysis. Stay tuned to the Market Guys, especially the website, so you can join us for some more live sessions and have your questions answered. Again, this is AJ Monty with the Market Guys. We'll speak with you soon.